The Fed will deliver its next interest rate decision on Wednesday. Our next guest says that the focus for investors should be on the central bank's dot plot, its balance sheet, and its rhetoric. So joining us right now is Lindsay Rosner. She's the head of multi-sector fixed income investing at Goldman Sachs Asset Management. And Lindsay, if you're reading any of the fine print, if you're watching what's happened just with the last couple of data points on inflation, it does feel like rate cuts have gotten pushed back a little bit. Maybe we won't see as many this year. It certainly seems to be what the Treasury market is telling us with higher yields.
Yeah, that's absolutely true. The Treasury market has completely repriced what they think the Fed is going to do. We started off just 2 months ago saying 150 basis points in cuts. Now it's 75. That is in line with the dot plot we last received. We will get a new one on Wednesday. That's absolutely true. And I think there's a likelihood, and it's all math, right? It's arithmetically possible to go from 3 dots to 2 dots. But the big picture for us is the Fed actually puts those dots out there for information and forward guidance. But let's be clear, they haven't followed those dots, right? The cuts that we had were emergency cuts. There was no dot plot saying post-COVID they were going to do emergency cuts. And on the way back up as well, they were more aggressive than the dot plot suggested, doing 50s, 75s to catch inflation. So the dot plot's helpful, but we don't think that it's something that you have to be super concerned about if you see 3 dots go to 2.
But it does suggest that inflation is a bigger problem. We've seen the higher numbers with the PCE and with the PPI and the CPI numbers recently. If the dots change, that's going to suggest to people that the Fed is more worried that inflation has not been cured yet.
Yeah, so it is absolutely in a correct downward trend, right? It is working. And I think if you look outside the window, we are in a soft landing. This is actually happening, and we're seeing the numbers come down. January, we're definitely hot inflation prints. February, not as hot, but still maybe not exactly where the market wanted it. But the trend is in the right place. And that's why on Wednesday, it's really important to look at the estimates that we'll also get from the Fed and listen to the rhetoric. What Powell says will be very important. We think he's going to continue with the message that inflation is trending in the right direction. But this isn't a straight, easy path, right? It's going to be a little bit bumpy.
Like the odds are you will get a little more hawkish commentary than you did when he spoke before. It was not the House, but the Senate, when he was speaking before the Senate, when he said it feels like it's coming sooner rather than later, essentially. If I were trying to measure with some very specific seismic reading, I might turn it up a little more towards hawkish to say I expect that he's not going to say quite as much.
Well, I think he gave himself a really good space there. And why I say that is because the Fed introduced a new metric, which is confidence, right? And back to precision. Confidence isn't something you can have with precision or knowing how somebody else feels in terms of their confidence. So I think Powell gave himself the space to be really open in this meeting and in the messaging. And that's good because they're data dependent and the data is really moving.
For fixed income, it's a pretty open market. There is liquidity, whether you are investment grade or even maybe junk bond status at this point right now. The market's pretty open, right?
Yeah, the market's wide open. Actually, a lot of sell-side firms are bringing up their estimates for what they think is going to happen in terms of issuance, meaning it's so wide open and levels have become more attractive or companies can wrap their heads around cost of capital that probably more companies are going to come to market rather than less. But yes, the markets are really open. They're liquid. For us, the real opportunity here is not buying the market writ large. It's about finding the different pockets of value in the market. And we're active managers, and that's what we do.
So where are they?
Well, some interesting areas are structured product. We really like structured product. That's an area that people were nervous about last year, specifically commercial real estate. I think as there's some more clarity around the cost of capital going forward, we do think that the Fed is going to start cutting in June. That gives some foresight or some insight into where your cost of capital is in the future. And I think we're seeing all these markets really normalize. The labor market's normalizing. Inflation is downward trending. And the biggest thing, and that is like the pot of gold right now in the economy, is that the economy is super strong. It's more robust and more resilient at these high interest costs than anyone anticipated.
With a really strong economy and fixed income markets that are wide open for just about anybody who wants money, that's not an argument for cutting rates.
Well, it's not an argument for cutting a lot. And I think that's the big shift that we need to wrap our heads around, which is this could just be a more shallow cycle. It doesn't mean that the Fed doesn't cut. They just don't have to cut as much. And I think that's the important thing to figure out. So if you're projecting
why do they
out,
cut at all if things are looking pretty good?
Right. Well, they are looking good, but there is some softness, right? If you looked at the labor market 6 months ago, it was stronger than it is now. There are certain things that are coming in terms of data prints. Look at retail sales. That is softer. So it's not just gangbusters growth, no problem whatsoever in the economy. We do have a soft landing, but things can change. And so it is important, I think, for them to begin the process of getting to the rate that they tell us is the neutral rate, which they are not at right now.
No, I think they're still deciding what the neutral rate is, though.
Yes, and I think we'll hear potentially a little bit about that on Wednesday as well. So this isn't a meeting where we're going to have certainly not a hike, definitely not a cut, but we are going to get a lot of information about how they're thinking. And to your point, I think that long-term rate, the neutral rate, is probably a little bit higher, as going forward, inflation is going to be at a higher level than we've probably experienced for the past 15 years on average.